Hello everyone, welcome to the M.O.W channel. Today, we'll begin our video on Bernie Madoff's investment scandal. Before we begin, please subscribe and like, as this will greatly help us in video production. Now, let's get started. Chapter 1 Genesis: The Rising Star of Wall Street. Bernard Lawrence Madoff. In the history of Wall Street, perhaps no name embodies such a stark duality. On one hand, he was a pioneer of financial innovation and a respected entrepreneur on the other, the architect of the most devastating lie in history. This chapter traces how Bernie Madoff, a young man from Brooklyn, ascended to power and prominence in the heart of American finance, and how, in the shadow of that success, he secretly planted the seeds of the Ponzi scheme. Humble beginnings and bold ambition. Bernie Madoff was born in Queens, New York, in 1938. His background was far removed from the typical Wall Street elite. His father worked as a plumber, before attempting a career in brokerage, which ultimately failed. In his teens, Madoff saved money, working as a lifeguard on the beach, and helped with a sprinkler installation business. This process of saving small amounts of money taught him not only the value of labor, but also how to accumulate and leverage capital. In 1960, Madoff founded his namesake company, Bernard L. Madoff Investment Securities BLMIS. He was just 22 years old. The company's starting capital was a mere $55,000. This money came from Madoff's savings as a lifeguard and from his in-laws. Compared to the massive investment banks of Wall Street at the time, BLMIS was a speck of dust, a small brokerage focusing primarily on penny stocks and over-the-counter OTC securities. However, Madoff was different from other founders. He was not just a broker, he was a technological innovator. The stock market of the early 1960s was the epitome of inefficiency. Orders were relayed by phone, trades were recorded on paper, and the speed of information transfer was slow and inaccurate. Wall Street, dominated by the New York Stock Exchange (NYSE), operated like an elite club, with high barriers to entry for small brokers and general investors. Madoff focused precisely on this inefficiency. Wall Street's technological revolutionary, Madoff was convinced that the future of financial trading lay in computers and automation. Instead of manually processing stock orders, he began using technology to serve as a market maker. Market makers provide liquidity by continuously quoting bid and ask prices. Madoff took orders from numerous small brokers and processed them through his proprietary computer systems. His innovation flourished in the so-called third market, operating outside the control of the NYSE at the time. This third market allowed for the off-exchange trading of listed stocks, and Madoff introduced an automated quotation system there. He built a system known as the Black Box, which dramatically increased the speed of transactions. This was an almost unimaginable advancement for the era. This technological progress brought Madoff explosive growth. By eliminating human error and delays inherent in manual trading and ensuring faster and more efficient order processing, he began to outperform larger securities firms. His company became a symbol of technology in the brokerage industry, and Madoff was hailed as a young innovator who shook up Wall Street's conservative system. The birth of NASDAQ and the power on Wall Street. Madoff's influence extended beyond the confines of his own firm. In 1971, he played a pivotal role in the founding of NASDAQ, National Association of Securities Dealers Automated Quotations. NASDAQ was the first stock market to operate based on an electronic communication network, rather than a traditional exchange floor. Madoff's technology and ideas formed the foundation of this new market. He served as a member of the NASDAQ Board of Governors, and later became its non-executive chairman. This position endowed him with the highest level of trust and authority in the financial community. One of his most successful, yet controversial, business practices that propelled his firm to immense size was the practice of payment for order flow. He paid retail brokers, such as E-Trade, for directing their clients' orders to his firm. Brokers sold their orders to Madoff, and Madoff rapidly executed those orders, profiting from the minuscule difference in the spread. He became one of Wall Street's most successful market makers, recognized as a tycoon who earned millions of dollars from his legitimate business alone. During this period, Bernie Madoff was the epitome of the successful American dream. He was perceived by the public as a pioneer who brought efficiency and broke down Wall Street's traditional barriers through technology. His offices were located in the Lipstick Building, a Manhattan landmark, and he occupied the entire 19th floor. One floor was dedicated to his thriving brokerage and market-making business, while another floor was used for his highly secretive asset management business. The start of a secret double life. In stark contrast to his dazzlingly successful brokerage business, Madoff's asset management division operated like a hidden vault. Madoff used the prestige of his brokerage firm as bait to attract investors. He cultivated an aura that his investment service was an exclusive club, accessible only to a select few of the wealthiest and most connected clients. Investing in his fund was viewed not merely as a financial transaction but as a social privilege, a sign of trust and recognition from a Wall Street mogul. It was within this secret asset management division that the largest financial fraud in history, the Ponzi scheme, began. Madoff claimed his Ponzi scheme started in the early 1990s. But subsequent investigations revealed that his lie had much deeper roots. In reality, as early as the 1970s, he was not investing his clients' money into actual stocks or bonds. Instead, he deposited his clients' funds into a single J.P. Morgan Chase bank account. This account was managed separately from his legitimate brokerage accounts. When a new client invested, the money was deposited there. When an earlier client requested a withdrawal or expected returns, money was simply taken from this deposited account to pay them. This process was akin to pouring water into a bottomless pit. While the early stages of his fraud may have been relatively small, the basic mechanism was perfectly established. It was the classic Ponzi method of using new investors' money to pay returns to older investors. Madoff hid behind his staggering success, perfectly evading the public eye. Because he was a symbol of trust in the financial community, no one questioned his claim of consistently high returns on investment. The hero of Wall Street had already secretly transformed into the boss of a criminal enterprise. He had built the foundation for his success, but beneath that foundation, a time bomb that would rock the financial world for decades had silently begun to tick. This was Madoff's first life, his life as a Wall Street magnate, but this brilliant life was merely a colossal lie waiting to collapse. Chapter 2: Development. The construction of the Kingdom of Lies. Bernie Madoff leveraged his title as a technological pioneer of Wall Street as his most potent weapon. While outwardly running a legitimate and flourishing market-making business, he was secretly cultivating the largest financial fraud in history. Behind the scenes, this chapter dissects the sophisticated systems and social engineering Madoff employed to build and sustain his kingdom of lies for decades. The secret of the Lipstick Building's 17th floor. Madoff's business was situated in the Lipstick Building in Manhattan, New York. The 19th floor housed his public, legitimate market-making and brokerage division. This space was the heart of modern Wall Street, filled with the latest computers and fast-paced traders. This business was genuinely lucrative, serving as the glittering facade that supported Madoff's reputation and credibility. However, the floor immediately below, the 17th floor, was a completely different world. It was a space that was tightly controlled and restricted. The 17th floor was the back office, where the Ponzi scheme was actually executed, a sanctuary entirely isolated from the outside world. Only a few loyal employees, including Madoff himself, had access. These individuals were not financial experts engaged in real trading, but people tasked with forging documents under Madoff's direction. Madoff claimed that his asset management service employed a specialized, complex options strategy called split strike conversion. This strategy was advertised as being able to generate steady and stable returns, regardless of market movements, by combining a stock portfolio tracking the S&P 100 index with simultaneous buying and selling of call and put options. Propagating such a complex and confusing investment technique was a deliberate deception. The complexity itself served as a shield, warding off questions from clients and regulatory authorities. The alchemy of fabricated returns. The primary duty of the 17th floor employees was retroactive fabrication. They never actually traded stocks. Instead, they fabricated fake trade records to achieve the consistent annual returns Madoff had promised, typically between 10 and 17%. Key employees, such as Frank DePascali and Annette Bongiorno, would check the actual movements of the S&P 100 index after the market closed each month. They would then work backward, creating fake trade logs that would result in Madoff's desired returns. They generated records showing specific stocks were bought and sold on certain dates, making it appear as though genuine transactions had occurred. Madoff sometimes instructed them to report artificially high returns, and at other times, he deliberately requested lower returns, recognizing that excessively high performance might arouse suspicion. All of this was meticulously calculated by Madoff, entirely independent of actual market fluctuations. To maintain this facade, they relied on outdated computer terminals and paper records, not actual exchange systems. Despite Madoff being a pioneer of advanced technology, his fraud division adhered to methods that were archaic and counterintuitive to the digital age. This was a sophisticated security measure intended to make trade records difficult to trace and minimize external exposure. Fake documents, including client account statements and trade confirmations, were manually typed or printed using antiquated printers to look authentic. These documents were the tangible evidence and foundation of the lie that allowed Madoff's scheme to endure for decades. Thus, Madoff built his colossal illusion through the unwavering blind faith in his reputation, and the labyrinth of fabricated paperwork. The psychological defenses of exclusivity and affinity fraud, a critical factor that allowed Madoff's fraud to operate successfully for such a long duration, was his strategy of affinity fraud combined with strict exclusive marketing. He did not randomly solicit investors from the general public. Instead, he concentrated on recruiting investors primarily within the wealthy and socially connected American Jewish community. Madoff was a generous donor and served on the boards of numerous Jewish charities, hospitals, and research institutes, establishing himself as a respected magnate within this community. Investors perceived him not merely as a financier, but as a trustworthy figure dedicated to their shared community. This social bond created blind loyalty, based on emotional trust and collective belief, rather than the cold analysis of a financial expert. Once one person invested with Madoff, the success story would immediately spread to friends, relatives, and business partners. Investing in Madoff's fund felt like a form of social endorsement and membership in an elite class. Furthermore, Madoff employed exclusive marketing. He never actively sought clients or begged for investments. Instead, he often presented difficult barriers to access or even refused investments from prospective clients. This tactic led investors to believe that Madoff's fund was so successful it didn't need new money, and that they were specially selected. This was a perfect manipulation of the human psyche, where people assign a higher value to something they desperately want but cannot easily obtain. As a result, investors hesitated to question Madoff or demand transparency, fearing they might be expelled from this exclusive club if they expressed doubt. The blind watchdogs. The institutional failure of the SEC, a decisive environmental factor that allowed Madoff's kingdom of lies to persist for decades, was the fatal failure of the Securities and Exchange Commission (SEC), the regulatory body of the U.S. financial system. Warning signs about Madoff's fraud began sounding as early as 1999. Harry Markopoulos, a financial analyst and options expert, analyzed Madoff's returns and realized they were mathematically impossible. The probability of the split-strike conversion strategy Madoff claimed to use generating such consistently high returns, regardless of market conditions, was astronomically low. Markopoulos determined that Madoff's return curve was too smooth. It had to be a graph drawn by hand, not the result of real financial market outcomes. Between 1999 and 2007, Markopoulos submitted detailed reports and evidence regarding the likelihood of Madoff's fraud to the SEC 5 times. His reports carried the blunt title, "The Largest Hedge Fund is a Fraud." He advised the SEC that the fraud would be immediately exposed if they simply subpoenaed Madoff's bank statements and client trade confirmations. However, the SEC dismissed these warnings repeatedly. SEC investigators did visit Madoff's firm, but their investigations were limited only to the legitimate brokerage division on the 19th floor. They failed to uncover the secret of the 17th floor, where the Ponzi scheme operated, and did not verify the most basic materials. Markopoulos requested the source of the funds in the client accounts and the actual trade records. Madoff later mocked the authorities, stating they never once asked him the right questions. The SEC's incompetence and negligence, combined with their blind trust in Madoff's reputation, led them to squander the final opportunities to stop the fraud. The fact that Madoff's niece was married to a former SEC compliance official further intensified the suspicions of impropriety and institutional blindness. The flawed auditors. The complete neutralization of external oversight was also significantly due to Madoff's accounting auditor. The firm responsible for auditing Madoff's multi-billion-dollar fund was Freeling and Horowitz CPA. This accounting firm was a tiny operation, based out of a small office in a suburban strip mall in New York. Furthermore, one of the firm's partners was a Madoff family friend. Essentially, a single accountant, David Freeling, was responsible for auditing Madoff's asset management operation, which supposedly handled billions of dollars. This situation defied common sense. A standard financial audit requires contacting independent third-party institutions to confirm the existence of the investment portfolio. Freeling, however, simply accepted the documentation Madoff provided and rubber-stamped the audit without proper verification procedures. He acted essentially as Madoff's puppet, providing the fraud with a veneer of legitimacy. The combination of regulatory indifference, the blind cooperation of the external auditor, and the overwhelming prestige of Madoff allowed the kingdom of lies to endure for decades. It was only when the global financial markets began to shake in 2008 that this colossal fraud finally faced the threat of collapse. Chapter 3 Crisis: The Confession and Arrest of the Downfall. Bernie Madoff's kingdom of lies stood firm for nearly 4 decades. Although his fraud, as a Ponzi scheme, carried the inherent limitation of relying on a relentless influx of new investors' funds, Madoff seemed to overcome this weakness, shielded by his authority, prestige, and the financial community's blind trust. However, the global financial crisis that swept the world's markets in 2008 became the decisive catalyst that brought this colossal fraud to an end. The financial tsunami and the liquidity drain. In September 2008, when Lehman Brothers collapsed and the global financial system seized up, the market was gripped by fear. Investors began a massive sell-off to convert all assets, stocks, and real estate into cash. The wealthy individuals, hedge funds, investment advisors, and most crucially, his longtime client base of charitable organizations who had entrusted Madoff with their money, were no exception. They collectively dumped large-scale redemption requests onto Madoff's fund. Madoff had weathered smaller withdrawal requests in the past, managing to overcome those crises by attracting new investors or persuading existing clients to wait. But the situation in 2008 was different. The financial crisis nearly completely halted the inflow of new capital. With the entire world hoarding cash, no one was releasing money for new investments. The scale of the redemption requests quickly became unmanageable. Requests totaling over $7 billion poured into Madoff's company. This money, of course, did not exist. Madoff had merely parked the investment funds in his business account at J.P. Morgan Chase Bank. This account had served as the cash reservoir for the Ponzi scheme. The account balance, which had contained billions before the crisis, began to dwindle rapidly as redemptions flooded in. Madoff desperately scrambled to resolve the situation. He attempted to borrow money from banks and other financial institutions, but in the midst of the financial crisis, no one was willing to lend him the massive funds he needed. The money earned from his legitimate brokerage business was nowhere near enough to plug the hole in the Ponzi scheme. The balance in Madoff's J.P. Morgan Chase account plummeted from $5.5 billion in early December 2008 to less than $234 million. There was no longer any money left to pay returns to prior investors or process client withdrawal demands. The kingdom of lies he had built over decades was instantly washed away by the tide of liquidity depletion. The catastrophic confession to his sons. Realizing the imminent collapse, Madoff was forced to reveal the truth to those closest to him. On the evening of December 10, 2008, Madoff met with his 2 sons, Mark and Andrew, in his luxurious Manhattan penthouse, with his wife Ruth present. Both sons worked in the legitimate brokerage side of their father's business and maintained they knew nothing of the Ponzi scheme. Madoff admitted to his sons that his business could no longer be sustained. He initially asked them to help him arrange a prepayment of a $170 million bonus to his longtime friend and accountant, David Freeling. When his sons questioned the legality of this massive bonus, Madoff finally dropped the bomb. He confessed that his asset management business was just one big lie and a giant Ponzi scheme. He stated that everything had been a fraud and that he had nothing left. After delivering this shocking truth, Madoff pleaded with his sons to give him a few days to tie up the loose ends of the business. In this moment, he attempted to use his authority to drag his own sons into the final stages of the criminal cover-up. Contrary to Madoff's expectations, his sons did not cooperate with his request. Mark and Andrew were consumed by shock and betrayal, and they refused their father's demand. They immediately sought out a lawyer, and following legal advice, They reported their father's confession to federal prosecutors and the Securities and Exchange Commission (SEC) that very night. Their report marked the official beginning of the end for Madoff's secret fraud, the FBI arrest and global shock. The morning after his son's report, on December 11, 2008, Madoff's fate was sealed. Agents from the Federal Bureau of Investigation (FBI) headed to Madoff's Manhattan penthouse. Madoff greeted the FBI agents in the living room of his luxury apartment. When the agents questioned him about his business, Madoff calmly admitted everything. FBI agent, we understand. You have been struggling to meet recent redemption requests. Why is that? Bernie Madoff, hesitating briefly. I have no money left. It was all just one big lie. Madoff confessed that his business was a Ponzi scheme and that all returns reported to investors were false. He admitted that his fraud had been ongoing for decades, confirming the scale of his crime was beyond imagination. That day, Madoff was arrested by the FBI on charges of securities fraud. The respected Wall Street mogul, former NASDAQ chairman, and symbol of success, was reduced to a notorious swindler in a single day. News of his arrest sent shockwaves through global financial markets and society. The estimated amount of the fraud linked to Madoff's name initially stood at $50 billion, but it was later estimated at up to $65 billion, including the fictitious returns credited to victims. This was the largest financial fraud ever committed by a single individual in history. While this figure was based on the balance in the fraudulent statements Madoff sent to investors, the actual principal loss was estimated at approximately $18 billion. But the scope and depth of the damage were immeasurable. The extensive scope of the victims. Unlike typical financial fraud, the scale of Madoff's scheme and the extent of the damage were vast and complex. His victims were not limited to merely wealthy individuals. 1. Charities and foundations. Because Madoff specifically targeted the Jewish community, numerous Jewish charitable organizations and foundations, including Hadassah and the Elie Wiesel Foundation, lost their entire endowments. This resulted in the suspension or severe disruption of countless humanitarian aid efforts and research projects. Madoff's crime was dual. He not only stole money, but also plundered funds designated for good works. 2. Hedge funds and banks. Large institutional investors, including major overseas banks and funds like those managed by the Spanish bank Santander, sometimes referred to as the Medici family of Venezuela, which had invested in Madoff's funds, suffered huge losses. They trusted Madoff's reputation and failed to conduct proper due diligence before investing. 3. Retirees and ordinary people. Although the majority of direct investors were wealthy individuals, many had invested indirectly through various investment advisors and brokerage firms. Consequently, a significant number of the ultimate victims included ordinary elderly people and middle-class citizens who lost their retirement savings. They experienced the tragedy of seeing their life savings vanish in an instant. Following the exposure of the fraud, Madoff posted a $10 million bail and was placed under house arrest in his New York penthouse. However, public fury was at an extreme. Victims expressing their rage gathered outside his apartment, and the media relentlessly denounced him. Madoff was already socially condemned before he even stood trial. The guilty plea and incarceration. On March 12, 2009, Madoff appeared in court and pleaded guilty to all charges. He admitted his guilt to a total of 11 felonies, including securities fraud, mail fraud, wire fraud, and money laundering. This guilty plea was a choice to avoid a trial, and he stated he would take responsibility for his actions. In court, Madoff maintained that he had committed the crime alone, and that his family and employees were unaware of the scheme's existence. However, this claim was later revealed to be an attempt to minimize his liability and protect his family. After the guilty plea, Judge Denny Chin revoked Madoff's bail and ordered his immediate incarceration. Judge Chin determined that Madoff posed a suicide risk and a risk of tampering with evidence by contacting co-conspirators. The Wall Street magnate was now confined to a solitary cell at the Metropolitan Correctional Center (MCC) in New York. The brief period between his arrest and incarceration rewrote the history of financial crime. Madoff's fraud transcended mere monetary losses, destroying the fundamental trust in the financial system. His catastrophic fall became a symbolic event that ignited public outrage over greed and corruption in the financial world. He now stood at the climax, awaiting the severe judgment for his actions. His sentencing. Chapter 4 Climax: The verdict and family tragedy. After pleading guilty in March 2009 and being immediately incarcerated, Bernie Madoff was no longer a Wall Street titan but an ordinary inmate. It was clear that his fraud was not merely a financial crime, but a moral bankruptcy that had destroyed countless lives. This chapter delves into the rigorous judicial process that led to his conviction and the devastating tragedy his greed inflicted upon the entire Madoff family. The anger and grief of the sentencing hearing. On June 29, 2009, the sentencing hearing that would determine Madoff's fate was held at the Southern District of New York courthouse. This proceeding was more than just a legal formality. It was an emotional crucible where the anger, sorrow, and frustration of the countless victims who had lost everything to Madoff erupted. The courtroom, presided over by Judge Danny Chin, resembled a modern-day tribunal of morality. While victims typically submit written statements at a sentencing hearing, the court, recognizing the severity of the case, allowed dozens of victims to testify directly in court about the impact of the fraud on their lives. Facing Madoff's cold gaze, the victims gave visceral accounts of how their lives had been shattered. One retiree described the devastating reality of losing their life savings and seeing their retirement plans obliterated, forcing them to search for work again. A representative of a charitable foundation funding cancer research testified that Madoff's crime had halted medical research that could have saved lives, emphasizing that his actions transcended mere financial loss to cause a humanitarian disaster. Notably, Elie Wiesel, a Holocaust survivor and Nobel Peace Prize laureate, stated that his foundation had not only lost everything to Madoff, but that his lifelong belief and human trust had been shattered, likening Madoff's acts to the work of the devil. The testimony that echoed through the courtroom laid bare the cold, calculating cruelty Madoff had hidden behind his glamorous Wall Street image. Victims desperately pleaded with the court to hand down the maximum sentence permitted by law. Madoff's apology and excuses. After the victims' heartbreaking testimonies concluded, Bernie Madoff was given the opportunity to speak. Looking gaunt after his pre-sentencing incarceration, Madoff, though still retaining an air of detachment, approached the microphone. He offered an apology for his crimes, but to many, his words sounded less like genuine remorse and more like a formulaic excuse. Madoff claimed that his crime had started small, but spiraled out of control and became unmanageable. He rationalized his actions by saying they stemmed from a fear of disappointing and harming others, not himself. He presented a typical self-justification, arguing that he initially intended to recover the funds and restore everything to normal. But as the situation worsened, he couldn't stop the lie. However, his claims failed to explain the scale and meticulous fabrication involved in a fraud that lasted for decades. The prosecution rebutted Madoff's statements as deceptive, asserting that he knew his actions were illegal from the moment he began the crime. Madoff's display of regret was interpreted not as genuine penitence for the harm he caused, but as self-pity for the loss of his own extravagant life. The law's severe judgment: 150 years in prison. After considering the closing arguments, the victim testimony, and Madoff's statement, Judge Danny Chin delivered the final sentence. Judge Chin categorized Madoff's crimes as extraordinarily evil and unprecedented. The judge pointed out that Madoff had intentionally destroyed the lives of countless individuals over a long period, and his lies had shaken the very foundations of the financial system. Judge Chin dismissed Madoff's apology as insufficient and untrustworthy, and granted the prosecution's request, sentencing him to 150 years in federal prison, the maximum possible penalty. This term was, in essence, a life sentence, far exceeding Madoff's life expectancy. Already in his 70s, the sentence ensured he would never enjoy another day of freedom. The sentence stood as one of the harshest penalties handed down by the American judiciary for a financial crime. The judge emphasized that the sentence would serve as a deterrent to others contemplating similar crimes and demonstrate that justice had been served. As the sentence was pronounced, victims in the courtroom reacted with a mixture of applause and tears. Bernie Madoff was officially branded not as a Wall Street magnate, but as a criminal destined to rot in prison for life. The shadow of ruin cast upon the family. Madoff's crime led not only to his own downfall, but also to an irreparable tragedy for his wife and 2 sons. While family members maintained they were unaware of the Ponzi scheme, they had enjoyed Madoff's fame and wealth, and thus could not escape the harsh condemnation of the public and the threat of legal action. The isolation of Ruth Madoff. Madoff's wife, Ruth Madoff, became completely isolated socially after the fraud was exposed. Although she claimed to know nothing of her husband's scheme, her luxurious lifestyle and alleged ignorance of her husband's business affairs fueled public suspicion. Following her husband's arrest, she claimed to have attempted suicide with him, but failed. She ultimately had to forfeit almost all of her wealth, including the Manhattan penthouse, the Palm Beach mansion, and millions of dollars in assets. This was a measure taken to avoid civil lawsuits filed by victims seeking compensation. Ruth was subsequently reduced to living a quiet, anonymous existence. The suicide of son Mark Madoff. The most shocking tragedy caused by Madoff's crime was the death of his elder son, Mark Madoff. Although Mark was instrumental in reporting his father's arrest, he became a target of public scorn and legal scrutiny due to his father's notoriety. He suffered immense psychological distress stemming from the betrayal by his father, the stain on his family name, and the collective rage of the victims. Exactly 2 years after his father's arrest, on December 11, 2010, Mark Madoff took his own life in his New York apartment. His $65 million fraud ultimately claimed his son's life, a horrific consequence. Mark's death was a tragic testament to the emotional devastation Madoff's crime inflicted on his own family. The illness and death of son Andrew Madoff. The other son, Andrew Madoff, was also a victim of his father's fraud. Andrew had worked at his father's firm, but insisted he was not involved in the Ponzi scheme. However, like Mark, he endured constant public criticism and legal pressure. Andrew was already battling a rare form of cancer, mantle cell lymphoma, and the stress and emotional turmoil severely complicated his fight. Andrew ultimately passed away in September 2014 while battling the cancer. Before his death, he expressed deep hatred, stating, he felt no pity for his father. The involvement of brother Peter Madoff. Bernie Madoff's younger brother, Peter Madoff, was the chief compliance officer of Bernard L. Madoff Investment Securities. Although he claimed not to have directly known about his brother's Ponzi scheme, he was charged with helping falsify company records and operations. He pleaded guilty to conspiracy to commit securities fraud and falsifying records and was sentenced to 10 years in prison in 2012. Madoff's crime extended beyond his immediate family, sending his brother to prison and utterly destroying the Madoff dynasty. The 150-year sentence and the tragic collapse of his family were the inevitable consequences of Bernie Madoff's greed and lies. He was now destined to serve his life sentence at the Butner Federal Correctional Complex in North Carolina, and his story remains a historical lesson on the depths of human avarice. Chapter 5 Conclusion Imprisonment and the Enduring Legacy. On June 29, 2009, Bernie Madoff was sentenced to 150 years in prison, a de facto life sentence, and transferred to the Butner Federal Correctional Complex in North Carolina. The extravagant life he had lived as a Wall Street magnate was replaced by the cold, monotonous routine of prison. This final chapter documents Madoff's incarceration and final journey, leading to his death, and the enduring legacy of his fraud on the financial system, and the painstaking recovery efforts for his victims. Life at Butner. The end of the liar. Bernie Madoff was confined to a medium-security facility at Butner Federal Correctional Complex, the place where he would spend the rest of his natural life. Once the owner of Manhattan penthouses, luxury yachts, and Palm Beach estates, his world was now reduced to a narrow cell and restricted communal areas. During his incarceration, Madoff maintained his characteristic cynicism. In interviews with the press, he boastfully claimed he was treated like a mafia boss, asserting his influence even behind bars. Rumors circulated that he had earned a notorious reputation among other inmates, and at one point attempted to control the prison commissary market. These actions demonstrated his unchanged personality, still attempting control and manipulation. Just as he had manipulated the financial system, Madoff continued his efforts to rationalize his actions even in prison. While offering perfunctory apologies to the victims for his crime, he subtly maintained that the damage was not entirely his fault. He blamed the Ponzi scheme's longevity on the incompetence of the SEC, the regulatory body, and attempted to relativize his crime by pointing out the structural flaws inherent in the financial system itself. However, these claims were widely dismissed as a shameless attempt to evade full responsibility. Declining health and the plea for compassionate release. More than a decade after his sentencing, in late 2019, Madoff's health began to decline rapidly. He suffered from end-stage renal disease, along with hypertension and cardiovascular conditions. Medical records indicated that his prognosis by 2020 was a survival rate of less than 1 year, Based on his critical health status, his lawyers officially filed a motion with the court for compassionate release. Madoff's legal team pleaded that he no longer posed a threat to society and requested that, on humanitarian grounds, he be allowed to spend his remaining time outside of prison with his family. However, this request met with fierce opposition from both the court and the victims. The Department of Justice argued that Madoff's crime was too extensive and devastating for his sentence to be commuted. Specifically, Judge Shira A. Shendlin, who took over from Judge Danny Chin, reviewed and denied Madoff's request for release. The judge ruled that Madoff's crimes had shattered the lives of thousands, and commuting his sentence would be an affront to judicial justice. The judge also pointedly recalled Madoff's indifference to his own victims, many of whom faced life-threatening situations, stating she could not grant his request. This denial crushed Madoff's last hope, reaffirming the severity of the price he had to pay for his crimes. He was forced to spend his remaining time enduring painful illness behind bars. The death of Bernie Madoff. On April 14, 2021, Bernie Madoff died at the age of 82 at the Butner Federal Medical Center in North Carolina. His cause of death was reported as natural causes, presumed to be complications from his terminal kidney disease. Madoff's death was reported globally as breaking news, but the public reaction was complex. While some felt relief that he had finally paid the ultimate price in prison, many victims expressed anger, feeling his death was too peaceful. They were unable to shake the feeling that he had escaped through suffering and accountability for his crime. To the victims, his death felt not like liberation, but an incomplete conclusion to justice. With his death, Bernie Madoff was finally relieved of his physical punishment, yet the financial, legal, and moral legacy he left behind continues to rock the world. The persistent pursuit of the trustee and recovery efforts. The figure who brought hope to the victims after Madoff's fraud was exposed was the court-appointed bankruptcy trustee, Irving H. Picard. Picard waged a complex and tenacious legal battle against individuals and institutions that were either complicit in Madoff's Ponzi scheme or had profited unfairly from it. His goal was to recover and return money to those who had invested with Madoff. Due to the nature of the Ponzi scheme, some of Madoff's earliest investors had received fictitious profits, which were actually the principal of later investors. Picard filed clawback lawsuits to recover these funds from those who had received false profits. This process was highly contentious and complicated, as those being sued for recoupment also claimed to be victims. Thanks to Picard's efforts, by the time Madoff died in 2021, over $14.4 billion had been distributed in compensation to victims. This was a remarkable achievement, recovering the majority of the estimated $18 billion in principal losses from the fraud. The compensation funds were sourced from Madoff's legitimate brokerage income, money recovered from false profit recipients, and settlement funds from financial institutions that were accused of enabling Madoff's crime. This recovery work continued even after Madoff's death, significantly contributing to the healing of the material wounds left by his scheme. The legacy left on the financial system. The Bernie Madoff scandal was not merely the crime of one individual. It left an indelible lesson on the regulatory systems of the U.S. and global finance. 1. Catalyst for SEC reform. The Madoff debacle exposed the fatal failures of the U.S. Securities and Exchange Commission (SEC). The agency's incompetence, ignoring multiple warnings from whistleblowers like Harry Markopolos and failing to carry out even basic investigative procedures, led to widespread calls for sweeping reform. Following this event, the SEC attempted fundamental changes in its regulatory approach, strengthening internal oversight, enhancing the use of information technology, and granting more power and compensation to its whistleblower programs. 2. Increased responsibility for financial institutions. Major correspondent banks for Madoff, such as J.P. Morgan Chase, faced criticism for neglecting to report suspicious transactions. Despite having the ability to detect his fraudulent activities, this event led to stronger regulations, compelling financial institutions to take greater responsibility for their anti-money laundering, AML obligations and the reporting of suspicious activities. J.P. Morgan ultimately had to pay billions of dollars in fines and settlements related to the Madoff case. 3. Erosion of investor trust. Madoff's fraud fundamentally shattered the public's confidence in elite Wall Street investment professionals and complex financial products. Investors no longer blindly trust exclusive investment opportunities, promising high returns. The demand for transparency and independent oversight has increased significantly. Bernie Madoff squandered every opportunity he had to end his life with honor. He could have been celebrated as a technological innovator, but he is instead recorded as the most notorious swindler in history. His name is now permanently remembered as the symbol of a destructive legacy, born from the convergence of financial greed, arrogance, and the endless human urge for deception. His story concludes with a stark warning to all participants in the financial market. Trust is hard-earned and easily destroyed. That's all for today's story. What did you think? We'll be back tomorrow with a new story. Please subscribe and like.